Hi, I'm Linda Lovey, Wealth Management. I'm an independent financial advisor and investment advisor rep. So one of the things I do is I show a lot of solutions to my clients to help them meet whatever issues they may have. In addition to the solutions, I also show them different strategies to put those solutions into place. So one of the strategies that I use is what I call a tax control triangle. So with that being said, how many ways are there to invest money from a tax standpoint?
Roth.
That's one of them.
401k.
So there's basically 3 ways to invest money
Before taxes.
from a tax standpoint. So one of your first ways would be, let's say, your pre-tax. That's where your 401k fits in. Anybody think of any other pre-tax ways? I'm sorry? Yep. Yep. A sub-plan, simple plan. Your traditional IRA also fits in here. We call this a 401 or a 1099 later because later on, when you start taking money out of this, that's when you start paying the taxes on it every year. Okay, so if there's pre-tax, what do you think another way of paying taxes would be? Or investing tax-wise?
Post-tax.
You got it. And now my marker's not going to work. All right, so that would be an example where you get your paycheck, you put your money in your checking account, maybe you put it in a savings account, or you buy a CD, that kind of stuff, so on. We call this 1099 now. Because every year, at the end of the year, you get a 1099 showing you how much money you've earned on it, and you pay the taxes as you go. So, another way would be after tax. Oh, I can't believe this. Tax deferred, and if you do it right, tax free. This is where your Roth IRA fits in. This is where your cash value of life insurance fits in. And municipal bonds fit in here. So we call this 1099 never. All right, so most of the people that I meet, they'll have a big pile here. And especially over here, they'll have a big pile because it's through their work, it's taking out their paycheck, there's a lot more information out there about it. But they won't have very much up here. You think, well, so what? Who cares? All right, well, this is the impact of it. This guy up here is 100% tax free. Where these guys are 100% taxed. So what does that mean? Let's say you get ready to retire. Say, throw out a number. What do you think on an annual basis? How much money do you think you'll need to retire with?
$1.5 million.
But each on an annual basis.
Oh, on an annual.
Yeah.
Oh, $1.5 million.
Yeah, I was going to say, well, that's a little bit high up high.
40,000.
Okay, so let's say you want 40,000. So you take out 40,000 out of these guys here, because that's where everybody's got most of their money at. But in order to actually net 40,000, you have to take out 40,000 plus what your tax bill is going to be, so that you get the 40,000. So that means you're actually doing more out. So now you have to pay out even more in taxes. So you're basically paying taxes on the taxes you have to take out. So instead of creating a cycle where you're having to take out more and more, what you do is you take the money out of here to pay your tax bill. So you pay the taxes due on these guys here. And by doing so, you get to create a higher lifestyle. But you get to stay in the lower tax bracket. basically, it's a legal way to keep more of your money instead of giving it to Uncle Sam. So I try to help people get started with these kind of strategies to complement what they've got going on, so that later in life, they won't have so much to have to give away to Uncle Sam. Any questions?
I like that.
Yes.
So Linda, how do you figure out, given the amount of money that you want on an annual basis, how do you figure that as to, say, however old you are, how much you need to put in every year to reach that goal?
So first thing what I would do is start a person off and let's say, if you figure out what you want to have in retirement, and then you want to build up to what that number is. So for example, a good rule of thumb is, if you take 4% of what you have in your assets out on an annual basis, it'll lessen your chances of outliving it. So for example, if you wanted $40,000 a year in income, you would need to have $1 million saved up by the time you get ready to retire. So you take your age, divide that into your $1 million, kind of come up with what you think your risk tolerance is for what your rate of return is that you want to go for, and build from there. So. I'm sorry? Okay, so yeah, if anybody has any questions, please feel free to give me a call. My number is 775-544-4714. And you can also look me up under L. Lovey Wealth Management. And I'd love to help you. No charge for consultation.